Why don't we jump right into it? Now, there's a lot of information to cover. We're not going to spend so much time on selling aspects and real estate. I think a lot of the value is going to come from what Yuliya and Donna are going to provide today. But we are going to touch a little bit about something that happened just recently. Prop 19 was a big change for a lot of people when it comes to property taxes and what happens when you have a property that's owned by the family and somebody passes away. And for the longest time, you didn't have to worry because you would inherit the property tax basis from your parents when they passed away. No longer the case. And I think this plays a bigger role, more so now or today than it ever has in the past, because it's forcing a lot of people to reconsider, should I really keep the property in the family or should I sell it? And those selling considerations and how they affect estate planning and how they affect from a lending perspective is important. So topics for today, as I just touched on, benefits of downsizing, importance of estate planning, the overview of estate planning, and key factors when you really start to work out that estate plan. Benefits for obviously you, your heirs, your essentially your entire family. So lending products for downsizing, how they play a role, and real estate selling strategies. May or may not come to that, but we'll see. Okay, so let's get right into it. So benefits of downsizing. What does downsizing really mean? Well, if you have a family like myself, come from a big family, our family is myself, my partner, Melanie, that you may or may not know. She runs the other side of the business when it comes to real estate, both selling and buying. And so we have 3 kids. And so we have a larger house as a result, or a larger place. And eventually, when they're all off to college and they're on their own lives and they have their own places, do we really need such a big place? And that's when you start to consider downsizing, going from something that's larger, 3, 4, 5 bedroom, down to maybe just 1 bedroom because it's just you and your partner at that point. So if you're thinking about later in life when you are empty nesters and you don't have the need to have so many people, so many rooms around because you don't have as many people around, then it makes sense to downsize. You don't have to clean such a big place, and you don't really have to furnish such a big place. So decluttering, try to get into something smaller, get into a place where you might want to retire in the future. Maybe it's a condo in a favorite city. Well, wherever the case, some of the things that are the benefits of downsizing is cost savings, right? You have a bigger place, there's just more maintenance, right? There's more costs associated with it. Insurance is higher. Your we'll get into property taxes because there's something about property taxes that's you won't save on property taxes, but you definitely save on your mortgage if you end up having a mortgage in the future for whatever you're buying, or if you have things related to the property outside of maintenance and insurance and things like that. So there is a significant cost savings there. Obviously, it gives you opportunity to be mobile, to explore the world. And given we just got out of the pandemic and a lot of people just feel like they've been stuck in the same place for so long that 3 years felt like 30 years, then gives you opportunity to explore different countries, different states, different cities. So there is a huge benefit to downsizing. And the thing about downsizing is that it does have benefits, but it also has a lot of risks and a lot of considerations that you need to take into account. And that's where we start to think about estate planning, and you think about lending and things like that. So good segue as we start to talk about estate planning. Why, Yuliya, why is it important to even consider estate planning when you're starting to think about downsizing, or when you start to think about later on in life? What do you see with your clients? What are they considering? What are they thinking about? Oh, you might be on mute.
You're mute.
Yep, I saw that. Thank you. Thank you, Lawrence. Yes, definitely. I think it's like I said, it's one of those aspects of our lives that's underestimated. And I think estate planning affects many, many aspects of our lives because it's pretty much, I don't want to say everywhere, but we come across it. It doesn't have to deal with something gruesome like somebody dying necessarily. It could be a simple power of attorney. It could be something that just needs to be done because somebody is unavailable. So it just happens that I think it's not one form that fits everyone. It's a very flexible process that allows you to figure out what works for you and what you need and what your client needs, because otherwise it's like, why would you need somebody to do it for you, right? So let's talk about what does this estate planning do? Like, what does it do for you? It's the process of designating who will receive your assets in the event of your death or incapacitation, right? So we're trying to figure out what needs to be done. And we're trying to make sure things are in order if things are happening or not happening. Again, I said it a few minutes ago, it doesn't have to be death. We're talking about incapacitation. I'm working with a client right now whose paperwork I did 5 years ago, and she's incapacitated now. So now working with her agent, whom she nominated 5 years ago. So it has to deal with her losing capacity, mental health, or even physical health. So that's kind of what estate planning does. It allows you to verbalize what you want, how you want things done. It allows you to maintain control after you're not able to do it yourself, or after you're gone, or again, in case of incapacity, whether it's physical incapacity or mental incapacity. So let's talk about a little bit about the most common misconceptions. So I think that's, again, something that comes up all the time in my practice. I've actually started asking clients now when they call me and say, I need a trust. I ask them, why do you think you need it? So I want to understand what their understanding is. And a lot of times I'd say it's not even 50-50. I think it's 70-30, that 70% of the time, whatever they're telling me does not even apply to them. So my job is to explain. So again, one of the things that people say, oh, I don't need it, I'm too young, or I'm not old enough. And to be honest, my youngest client was 22 and she did not have any assets. I think she had $50,000 in her bank account, but she just wanted to make sure things were in order. So I think estate planning has no age. So then the other one is that trusts and wills are for rich people, because people assume I don't have an estate. Why do I need it? Because people assume that an estate is something that's so big and it's like a vineyard in Napa or something that's huge. And we'll talk about what estate is in just a few minutes, but again, it doesn't apply. And then some people say my spouse knows what to do. And of course, in many relationships, and I think it's more common than not that one spouse takes the lead on a lot of things when it comes to financial things and like property stuff. So usually it's one spouse who kind of oversees everything and the other one kind of assume that everything is taken care of. Again, it's great. But then if the spouse who is in control of things goes away or is no longer around, who's going to deal with it? Another misconception is my children know what to do with me. Oh, you'd be surprised. Very often I hear, oh, I have a normal family. They know what to do. Again, unfortunately, when people see dollar signs, it becomes not as pretty. So it happens. And then next one would be that the state knows what to do. I know a lot of attorneys use this phrase that if you don't have a plan, the state will have one for you and you're not going to like it. And that's essentially what's going to happen. And the last one is that people say, I don't really care, I'd be dead. So why do I need to worry about it? So those are kind of the most common misconceptions. There are others that I come across, but these are the most common ones. So let's talk about what is it what is your estate? Like, what is it? Essentially, it's everything you own. It's just a fancy way to say assets. People say estate, and again, it causes a misconception because everything you own is your estate. It could be your nice dining room table. It could be a car. Basically, everything, whether it's liquid assets, meaning cash or bank accounts, or whether it's non-liquid assets like tangible personal property or your real estate. So those are all the things that the estate is comprised of. So this is what is included in your estate. So, and again, that's why people have these misconceptions, because the word estate, I think, is misleading itself. So let's talk a little bit about what your estate planning options are. And it's interesting because I see basically in my head that there are 3 estate planning options. And one of them is not doing anything. And that's what most people do these days. That's the choice of most people, because for one reason or another, whether it doesn't apply to them or whether they just choose not to, or they're procrastinating, they're not doing it. And it's free and they don't need to do anything. So by California law, we all know I mean, at least most of us know that there's a process called probate. And what is it? Essentially, what it says in California as of 2023, if you own assets that are in excess of 185,500 in liquid assets or 6,500 in real estate, everything above that amount would be subject to probate. What does it mean? If you own a property, let's say in San Francisco or in the Bay Area, of course, it's going to cost more than 65,000. What does it mean? It means that before that property goes to your children or your heirs or whomever you want it to go to, is going to go through the wonderful, wonderful process called probate, which means that the court's going to decide who's going to get what based on California law. Again, what does it mean? If you have a child, your child is going to be your beneficiary by law, but the child is not going to be able to access anything until it goes through the bureaucratical steps of the probate process, which has its own downsides, of course. One of them, it costs money. And the other one, that it takes a while, especially since the pandemic. Before the pandemic, it took roughly about 18 months, especially in San Francisco, 18 months to 2 years. Now it could take longer. I personally had a probate case that was in probate for 5 years. So it does take time. So it does only apply to assets above the threshold. If you don't own assets above those thresholds, 185 for liquid and 65 for real estate, it does not apply to you. But again, most people who own real estate, it does apply to them. The second option is using your will. It's a little bit more simple. You can draft it yourself. You can handwrite it if you want. You're able to express your wishes, but then at the same time, it still goes through probate. A will acts as an instruction sheet to a judge, essentially. It still goes through the same steps, but the judge knows what your wishes are. For example, if you don't have kids, or there's specific people that you want to leave your assets to or your estate to, you can express it in the will. Because if you don't have a will, then it's going to go by California law. And under California law, your next of kin is your kids, then it's your parents, then it's your siblings, and then it goes further out, kind of your lineage. So a will is a good way to start, but if you have access, again, in excess of the thresholds that I was talking about, it's not going to take you out of probate. And the third option is having a living trust. So there are different types of trust. The most common trust is called the revocable living trust. And that's the most common one that I see in my practice. It allows you some flexibility to do things and put things into it and take things out. And then it essentially allows you to not only express what your wishes are and who you want things to go to, but then it also avoids probate. And it doesn't take years, of course. And the only people who are allowed to access to your trust are the ones that you've nominated in your trust. So no strangers are going in looking at your stuff, like would be in the case of probate. So let me talk a little bit more about what happens if you don't have anything done, which is pretty much option number one, which is, again, the most common one. Unfortunately, people assume that everything's going to be fine and great for the rest of their lives. Nobody thinks about incapacity, which is something that I see more often in my practice than death. Because incapacity could be permanent or temporary. Somebody could be in a car accident. Somebody could be just temporarily in a hospital. So the question is, what happens? Like, who does stuff? Who will make medical decisions for you? Who will, like, let alone if you have your own business, who's going to run it? And the worst case scenario here is like you have no access to your finances. Nobody can access it. You potentially need to get a conservatorship from the courthouse and things like that. I'll give you a very specific example about incapacity. I was just contacted by a prospective client, a frantic child, adult child of a woman who was in her mid 40s, who fell into a coma unexpectedly. And she had a business to run. And what was happening? Nobody could do payroll. Nobody could do anything in terms of business operations because there was no power of attorney, and she was in a coma for several weeks. So the business was really stagnant and people were freaking out. If you have a power of attorney, then you can nominate somebody while you still can to do something like that. Again, unfortunately, she never came out of that coma, but if she did, she could come back and continue the operations. In her case, it was a little bit worse, not a little bit, much worse. So she never came out of it. And unfortunately, now the whole thing, the business and everything is going to have to go through probate, and it's going to be a lot more work to do than it would have been if things were spelled out in the paperwork. Same with medical decisions. Like if somebody is in a coma, do you want to be unplugged? Do you want to continue on the life prolonging treatment? It is very specific, very personal. Again, not everyone is comfortable talking about it, and some people say, again, I have a normal family. They know what to do with me, or they know what to do with my body. The way I look at it is if you spell out how you want things done, you're actually taking that burden away from your family. So it's hard enough to watch your loved ones being in that state. But then if you also have to make those decisions, it's going to make your life even more difficult, especially if you have family members who disagree. So that's where the issues come into play, where you have somebody who says, oh, let's keep her on the machines, or no, let's unplug, et cetera, et cetera. So that's one kind of type of what happens if you do nothing. Let's go to the next slide, and we talk about so that was incapacity. Now what happens when somebody passes away? Again, we're talking about the California law being the default where things go and how things are distributed versus you making those decisions. It becomes actually even more important, and nobody really thinks about it, that because I've talked to a lot of clients about it, a lot of professionals, people assume that estate planning is needed for a nice cute family with a married couple with a child with like white picketed fence and a house. But think about people who don't have kids, or think about unmarried individuals. Who is their next of kin? Or let's say we're talking about a committed relationship. Somebody's in a committed relationship, but they're not legally married. If something happens to one of them, the other one has no rights. So now that the more I practice law, especially estate planning, the more I realize that people who have no kids or people who are not married they have even less protection, especially under federal law, because if you're not married, like what protection do you have? You have nothing to do with the asset that you've shared with your loved one, for example, for the last 30 years. Or what if your next of kin is your parents or your siblings and you don't even talk to them and they're your heirs by default because you haven't written it out? I've had a pleasure of working with quite a few same-sex couples, and it's become even more important for them because some of them don't have children and they live in committed relationships. And unfortunately, a lot of times, especially with couples or individuals who come from, I'd say, I don't want to stereotype, but say Midwest, and sometimes they come to San Francisco because they're looking for that support and community, and their loved ones don't necessarily support their lifestyle. So by default, their family would be the next of kin, and they might not even talk to them. So this is why it's very important to make sure things are written out and it makes sense where things would go and what's going to happen if somebody's either incapacitated or were to be gone. Okay, I hope that makes sense, and feel free to ask questions. I know we have a Q&A chat open, so if anyone has any questions, please ask. Let's talk about what you need to do for estate planning, or like basic things that need to happen for you to at least even start thinking about it, because I think that's important. So I'm going to talk about 7 basic steps of estate planning and what I would always recommend to at least to get the process going. First thing is inventory what you have, because I think it's so important to make sure what you've got, and not only just for estate planning purposes, but just making sure that you have everything covered, whether it's for insurance purposes, whether it's for your own benefit, or even making a list for your loved ones so they know where to look for things. Because a lot of times people pass away and then it's a situation where the house is filled with things and nobody knows the value, nobody knows what it is. I mean, and sometimes people pass away and they have estate planning documents and nobody even knows they exist. I had a case where, again, a frantic adult child called me and said, my mom passed away, we know there is a trust but we can't find a copy of it. That happens. So you want to, again, make sure that everyone who's in your life is aware of your stuff, whether it's an inventory of your assets or whether it's an inventory of your paperwork. Okay, let's go to step 2. So step 2 would be to account for your family needs. Everyone is different. There is no solution for everybody. It has to fit. It has to be the right fit for you, your specific circumstances, your specific wishes, and your specific needs. It's not just your wishes, it's the needs. So LI is life insurance. So make sure life insurance is always great to make sure you, your heirs or your loved ones have a little bit of cash if something were to happen to somebody. Of course, when it comes to children, that's where it becomes real for a lot of people, especially when you have minor children. What happens to my child if something were to happen to both parents? Did you nominate a guardian? Did you, like, do you know who's going to take care of them? And by default in California right now, if there's no guardian nominated, the kid goes to foster care by law. Even if there's a perfectly great grandmother living across the street, it has to be done through the court. The court has to approve a guardian. And so there might be some time frame that the child would be in the foster system versus with his, let's say, grandma when the parents passed away. So I look at it, oh my God, it's tragic enough for a child to lose the parents, but if they have to go through the system and be in that system, even temporarily, that's not good. And another thing to mention, being in San Francisco with a lot of immigrants, I'm an immigrant myself, as you can tell, um, a lot of people have family outside of the country and they want the child potentially to go and live with the grandparents or to live someplace else. So the question is, yeah, let's nominate a grandma who lives, I don't know, in France or somewhere else. But what happens if somebody happens to the parents today and it takes grandma to get here? It takes her a week to get here. What happens to the child? So that's where I always recommend to clients, if you nominate somebody who doesn't live here, put a temporary guardian in place, nominate a neighbor or somebody that the child knows who's readily available, who's here to take care of that kid. It's just something that I've come across with by working with clients from all over the world, not just the country, just making sure that whoever is taking care of things, they need to be readily accessible. If somebody in another country, it's not as easy. Even if somebody's on the East Coast, it's not always as easy, but it's always nice to have a backup plan. I think my paranoia is very well developed, and I think it's essential to have a backup plan for everything. Okay, let's go to step 3. So step 3 would be establishing the documents after you've done the inventory and figured out what you need. So you want to have a medical directive. In California, it's called an advanced healthcare directive. Everywhere else in the country, it's called a living will. That's why we always hear, oh, she has a living will. It actually has nothing to do with the will. It's essentially power of attorney for healthcare. So that's where you specify how you want things done if you're not able to make your own decisions. Same with the regular power of attorney. We talked about it briefly for administrative things, financial things. You want to be careful, of course, whom you nominate to act on your behalf, because you don't want people doing stuff that you won't approve of. When it comes to powers of attorney, actually, I'm not sure how many of you know, but they've become a part of college applications now, college packets. So because once your child turns 18, they're no longer kids and they're adults, and you can't make decisions for them, even if you want to. So if your kid calls you and says, Mom, get me my vaccination records from my pediatrician. The pediatrician's office is not going to talk to you if your kid is 18. So think about those things. Again, it doesn't have to be anything gruesome. Nobody needs to die. Nobody needs to be in a coma. It could be just day-to-day stuff, or even your property. Something needs to be done with your property and you're traveling. I know I was traveling and Donna was actually doing a refi for my house a couple of years ago. I gave a power of attorney to my husband, and then I had one for my brother just in case something needed to be signed while I was gone. So again, it doesn't have to be anything gruesome or something that makes you feel like, oh my God, I don't want to think about it. I don't want to talk about it, let alone write about it, because I don't want to jinx it. I've had clients say that, but that's not what it's about. It's about being prepared. And we've talked about, we've already covered briefly the trust. You want to be able to express your wishes and bypass probate and make sure everyone knows where things are and how you want those things to go. So those are kind of things that you want to, steps that you want to take to actually cover yourself from all those different angles if you're ready to do it. Okay, let's go to step number 4. That's something that I can't say enough of. Review your beneficiaries. You'd be surprised how many retirement accounts go to exes, wives, ex-spouses, ex-girlfriends. So you want to make sure those are up to date. Don't ever leave the beneficiary section blank, because once something is blank and there is no beneficiary appointed for your insurance accounts, for life insurance, retirement accounts, or any other accounts, that's when it goes to probate. Because if there's a blank spot, where's it going to go? It goes to court, and the court decides where it's going to go next. So that's where I tell clients, make sure you have alternates or contingent beneficiaries. Most spouses have each other. Let's say retirement accounts, you have to have each other nominated unless the spouse signs a waiver. But then obviously spouses travel a lot together. So what happens if both are gone at the same time? Where does it go? Probate, if there is no contingent beneficiary. So review those things. I always recommend doing it on the annual basis, even if you're just planning to travel. Make sure just those things are kind of, the T's are crossed and the I's are dotted, just to make sure, just little things. I actually was in Las Vegas for spring break with my daughter and met this wonderful woman at a show, and she asked me what I did. I told her what I did. I gave her my card, and she called me a few months later saying her husband passed away, and she was able to get one of the insurance policies, retirement accounts, because she was named as a beneficiary, but somehow they forgot to put her down on the other policy. So now she has to go to probate to recover money that her husband left because there was no beneficiary in that account. Again, it's just something that happens all the time. Let's go to step 5. Know what you're dealing with. That's another thing. It's usually somebody that would be your CPA who can tell you, or your tax professional you're working with. Some states have estate taxes. California doesn't have that, which is great, but we all live in a country that has federal law that apply to all the states. So under federal law, the exemption rate for inheritance and estate is fairly high right now. So it's close to 13 million. What does it mean? It means that anyone could die peacefully if they own less than $13 million in their assets without having to pay state taxes. So if you own something that amounts to 15 million, your heirs or your beneficiaries or your loved ones would have to pay taxes on the excess. So if you own 15 million, they're going to have to pay taxes on 2,080,000. So that's something to think about. That figure changes all the time. So that's the 2023 figure. Several years ago, it was only 5 million. And if you live somewhere in the middle of the country, it's probably not as essential or important. But in California, when it was, especially Bay Area, when it was 5 million, I had a client who owned 3 pieces of property in the Bay Area, and they're coming pretty close to 5 million. If you're legally married, officially married, that amount doubles for married couples. So if you're happily married or unhappily married, that amount is close to a little bit over 25 million for you. Okay, let's go to step 6. Think about if you need help. So sometimes you have something that could be DIY option. So think about it. And if you're not sure, talk to somebody like myself, because again, I'm happy to provide that source of information and I'm happy to advise you of things. Give you an example. Don't assume that this is like Because somebody thinks, oh, I need a trust or I need this, and they're not really thinking why. That's why I ask clients, why do you think you need it? I was speaking with a client last week, and she is an American citizen who decided she didn't want to stay here. So she lives in Europe. And she called me and she said, I need a trust. And I said, why do you think I need a trust? And she tells me, oh, I have two accounts um, that are being handled by my financial advisor in the US with Schwab and somebody else I can't remember. And I want to make sure it goes to my daughter when I pass away. So my answer to her was, I don't think you need a trust. You can just put your daughter as a beneficiary. So we talked about it and she was like, oh, I never thought about it. And she kept talking to me about the trust. And I said, hey, I'm happy to charge you for the trust, but at this time, I don't see why you need to have it. So we had a nice conversation. She appreciated my straightforwardness because I wasn't just charging her for something she doesn't need. I actually told her why she doesn't need it. So think about what you need. If you're not sure, talk to an attorney, talk to other professionals, and they can guide you through it. Let's go to the last step. Step number 7. Plan to reassess. Life changes, things happen. So you want to make sure that it's a fluid process. It's not just you do it, you put it on the shelf and it's done. You want to make sure that if things change in your life, you contact the attorney you spoke with. If things change in your life and you don't have anything, talk to somebody about their opinion, whether you need something or not. It's easier to update things than start from scratch. So you want to, and it's better to have at least something in place than not have anything, because you can have a short-term solution. Let's say if you're traveling, you want to put something in place just for your own peace of mind. And then you can always, when you have more time and you have the finances to do something a little bit more elaborate, you can always reassess. So that's something that I always recommend to clients. It's not something you do and you forget about it. Make sure you come back to it. And last but not least, I want us to talk about, where do we start? Like, how do you start the process? So the main questions you want to ask yourself is, whom do you love or whom do you not love? So that's where it comes into play. Like I told you, by probate, things might go to people that you don't really want them to have anything of yours, right? Or any assets of yours. So make sure that people you love are compensated, and people, or not compensated, by taken care of, and people you don't love are not necessarily even in line to get anything from your assets. And then who are you responsible for? If you have minor children, if you're taking care of elderly, think about those things, because you want to make sure that things are in place before something happens. And the same, whom do you trust? You want to make sure people you nominate to act for you are the people that you trust fully. And those can change too over time. You might be feeling comfortable with somebody right now, but then in 10 years, it might not be the person you even talk to anymore. Same with guardians for your kids. I'm going to give you my own example. I nominated my friends several years ago to be guardians for my kids, and when the kids were little. And now that my kids are growing and I watch my friends' parental styles, I respectfully disagree with their parental style. I don't like it. I don't think it's going to work for my kids. So I'm reconsidering. And that's why it's a fluid process. You want to, and then when you have kids who are a little older, you want to ask your kids, what do you think? If I weren't your parent, whom would you be comfortable living with? So that's something, again, it's a conversation. So, and when you're ready to talk about these things, then it's when you're ready to start the process of even talking about estate planning or thinking about estate planning. I think that's all for me for today. Thank you everyone for listening. Let me know if you have any questions, and back to Lawrence.
No, that was so much information. It's almost like drinking from a fire hose. But everything you said was on point. I mean, we see it every day in the news, right? With those mass shootings, I remember seeing that family where they had two young kids, and they had a photo. It's like seared into my mind. And two happy parents, and both of them were killed in this mass shooting. And then you just had the kids, and that just opens up so many questions. And it's heartbreaking to think, well, they don't have their parents anymore. What happens next, right? So a lot of those, knowing that a lot of those possible situations could be answered through estate planning is very reassuring, for sure. Personally,
Exactly.
when you were talking about it, I didn't even think about it. We've gone through estate planning, and we had to identify who's going to take care of our kids. in the future if something were to happen to us. Because yeah, if we're traveling and something were to happen to both of us at the same time, and we identified somebody, but now realizing that decision was made, 5, 10+ years ago when the kids were very young, and we couldn't have a conversation with them about that. Now we can, because they're much older and they can understand and they can at least voice their opinion. So homework for me to do as well, for sure. But
Perfect.
But yeah, great information. What I forgot to do was tell everybody that's on the call that we do want to answer your questions. And the best way to do that, since this is a webinar style Zoom, is to type in your questions at any time during the seminar, and we'll address the questions at the very end. Now that I'm sharing that information now, the questions are probably going to start coming. So what we'll do is we'll save those questions to the end of the next section after Donna has a chance to talk, and we'll address all the questions at that time. But please do, anyone, feel free to send in your questions. Happy to, well, I'm not happy to answer it, but Yuliya or Donna will be able to answer it for you. Okay, so next, I believe we're going to be talking about lending.
Yes.
Is that right, Kat? Yes. Lending products for downsizing. And my gut reaction when thinking about downsizing is, or even think about, where I would be later on in my life, and would I really need a lending product? Why would I need a lending product, right? And I think reverse mortgages is right here. It's on this slide, and you'll touch upon that and anything else. But what would the scenarios be where we would need to start considering lending products?
Okay. So again, my name's Donna Aldrich. I'm a mortgage broker, and reverse mortgages have historically a very terrible reputation. So I'll start by saying they were all completely re-regulated in 2013. When I started in the business 20 years ago, I wouldn't have touched it with a 10-foot pole, but now I have found them very, very useful for many people in many different scenarios. And one common misunderstanding about them is you cannot purchase a home with a reverse mortgage. That is not true. And we can go to the next slide. Please. The object of a reverse mortgage is to allow seniors to remain in a home, either the one they're currently in or a new one, a downsized home, as Lawrence was mentioning. Typically, the way this works is you'll put down a larger down payment, and then you will have no mortgage payment for the duration of your residency in that home. So for as long as you live there, you have no payment. Your interest does become principal, so your mortgage can grow over time. But again, it doesn't impinge your cash flow, and you're using that equity for your lifestyle and for whatever else you might need it, medical, etc. We can move on. The requirements, well, the first question most people ask is, how much can I get? And that amount is called your principal limit. It's an algorithm, basically. It's a rather complicated calculation that takes into account your age, the value of the home, the amount that you're, and the amount that you're putting down. So it's a calculation we do on a case-by-case basis. And that will tell you how much loan you can get versus how much equity from your current home that you're selling that you need to put down. We can go on. These are the three main requirements of a reverse mortgage. You must be 62. We can start the process at 61 and a half, but you have to be 62 when we close the loan. You need to have a sizable down payment. The younger you are, the bigger the down payment will need to be. And you must live in the property as your primary residence. At any time you decide you're no longer going to live there, or you can't live there, then we have to look at how to resolve the mortgage. Okay, go. So when you pass or when you leave permanently for some other living situation, your heirs have 1 year to resolve the mortgage. So that doesn't mean we get to day 364 and they make a decision. It means if you weeks after you're no longer living there, if you've passed, your heirs will either sell the home and pay off the loan, or they can refinance it and retain it. Same if you leave to go to another living situation, then you, if you're not incapacitated, can decide to sell the home or have one of your family members take over and refinance it. But either way, within 365 days, the loan will need to be repaid. And that's what I was just talking about. There we go. We'll flip to the next one. So you can live in any of these types of properties, or this can you use for any of these types of properties: a single family home, a 2 to 4 unit home where you're occupying one of the units, a condo in a HUD approved project, or a manufactured home that meets any FHA requirements. And we can turn the page. There we go. There is what we call a financial assessment. One of the other benefits of a reverse is it's not quite as restrictive or strict about your financial qualifications. You need to prove that you've been paying your taxes on time, that you have enough cash flow to cover your living expenses and pay your taxes and insurance. Your credit history will be verified, but I will say I have helped half a dozen folks get out of a bankruptcy with a reverse mortgage because the requirements are, it's a lower bar. So it's not something that you have such a high bar to qualify for approval of a loan. So now we're going to move on from reverse to sort of a broad category of bridge loans. There are a number of types of bridge loans that we can use. We can go with a conventional lender. I have several who will do a bridge loan, and these are not necessarily, the boxes aren't matching up necessarily with the bullet points here, so I don't want to confuse anybody, but a conventional lender will do a bridge loan. You follow their guidelines, generally use a line of credit with one of their associated lending partners, and that'll have in my experience, lower limits available. So the maximum I've seen on a conventional bridge loan is about $250,000. That isn't always enough to help you leave your property. And the object of the bridge is to be able to move before you sell. Let's just put that out there. So there are some pretty limited options when it comes to conventional lending. With HELOCs, which is a home equity line of credit, if you have a good deal of equity in your home, we can draw that out on a line of credit. You can use that to put down on your new home, get into that property, and then sell your existing home and pay off the HELOC. Those rates are variable, but if there is a lot of equity, it's a decent option. And I do have one lender who has a quick qualifying loan. So if you fit neatly into their box, we can close that in about a week and a half. So that's a pretty easy, streamlined process. I have another lender who has something called a departing residence loan. And what that does is remove your existing housing expense from your debt to income ratio, allowing you to qualify for the new loan by basically extracting your mortgage payment, taxes, and insurance on your existing property. So this has been very useful with many of my clients. The loan limits are quite high, and either you pay a couple of points or you keep it for 6 months. So it's going to be a little more expensive than a conventional loan, but again, it's usually used as a short-term solution. And then finally, private money, also known as hard money loans. I have a great private money lender that I've used for years who have a bridge loan. And again, it's a little more expensive, but when you think your only other option is to pack up all your belongings, put them in storage, move to something temporary, spend the money on that, you're only going to be paying that higher interest rate for 2 to 4 months in most cases. So it's really not as expensive as it sounds. And any points you pay are also deductible, which is true of any of these loans. So that's a really efficient option. if you don't have a lot of equity, or you don't want to move twice. And what they do is cross collateralize, meaning they put the loan on both properties, and that allows them to give you enough to purchase the new home. In one case, I had a client who had enough equity that they didn't have to come with any down payment to obtain their new home, and then we paid off that private money loan when they sold their existing home. I was a little quicker than Yuliya, but happy to answer any questions. Lawrence?
So I always find it helpful to learn based on experiences from other people. Like, what are the situations that you've seen where somebody does need to consider some of these lending products? Like, for me, when I think about it, I think, wow, if somebody didn't really plan for their retirement and they didn't save up, they're in really big trouble, right? Because a lot of times, if you had the fortune of being able to buy something yourself and not just rent the rest of your life, then you actually have something that probably has built up equity over time, hence the reverse mortgage. But then maybe
Right.
you didn't save for your retirement, and so you're working, and then you get to a point where maybe you can't work anymore. You're just either too old or too tired to work anymore. And so how do you pay for your residence,
Expenses.
your
Mhm.
expenses, your living expenses? And I think from that perspective, it makes a lot of sense to have a reverse mortgage or have a lending product where it would work for you.
Right.
Now, that makes sense for me. When it comes to other situations where you might want to use a lending product to be able to sell your current place and then purchase another place, that's always a challenge, because you have that, like you were saying, you have to create a bridge, so to
Right.
speak, i.e. bridge loan. So do you have examples where you've helped clients recently in certain situations such as these?
Absolutely. So, I mean, a lot of people think of the reverse mortgage as a refinance tool, not a purchase tool, which is, so for the purposes of today, I focused on the purchase, but just to give you a couple of brief examples, and one of them I think is particularly important in light of what Yuliya was saying. I have a client who technically it's her daughter, who has come to me because her mother is living in a home that's worth $1.5 million, but her medical burn rate is like 20 grand a month. And she's about to run out of liquid cash, but she's sitting on $1.5 million in equity in this home. She's in her late 80s, so we could access a good deal of that. And this is going to cycle back to what Yuliya was talking about, and then I'll go back to mortgages. We have a power of attorney. Her daughter has a financial power of attorney. It was written 6 years ago. My lender can't use it unless we have a doctor's capacity letter stating that she was capable of making that decision at the time that she made it.
Hmm.
Since that didn't happen at the same time as the POA, now we have to find another doctor who will say she's at least competent to agree with her daughter's current decisions. So, advice of the day: when you do a power of attorney, do it in conjunction with a doctor's capacity letter. So if you do have to make these financial decisions in the future based on that power of attorney, you can show that it's legit. So that's just a quick aside that I keep thinking of based on that certain circumstance. Another purchase scenario: I had a woman who was referred to me by her realtor. She owned a house in San Francisco, and she was Hong Kong born Chinese. Her mother became ill, so she sold her house in San Francisco, moved back to Hong Kong to take care of her mother. Less than a year later, unfortunately, her mother passed. She didn't want to live there. She wanted to live here, but now she was cash rich and income poor. She didn't have a lot of cash flow coming in from Social Security or retirement or whatever, but she did have a fair amount of liquid capital. So what we did with her is she transferred a lot of that money to her US accounts. She purchased a home with about 60% down, She was in her 80s also, and now she lives in her nice home with no payment. All she has to do is make sure to take care of her taxes and her insurance. So again, if your situation is that you have in your using your example of downsizing, you have a fairly valuable home and a lot of equity in it, you can transfer some of that as a down payment into a new home with a reverse mortgage and not have to worry about coming up with a mortgage payment every month, especially if your income is diminished as you've retired. So that's one example of that downsizing. Sometimes with bridge loans, it's downsizing, sometimes it's upsizing, but at the end of the day, the bottom line is you want to buy before you sell. Because as a realtor, I'm sure you would agree that it's better if the occupants are no longer in the home. Then you can stage it and you can make it look appealing to a broader audience. It doesn't inconvenience the homeowners. However, many times that means, like I said before, they move into a temporary residence instead of moving into their new home. So it's more efficient and more pleasant for the homeowner to buy the new home, move into the new home, and then sell the old home. And that's where bridge loans come in to play. This way, the departing residence, I think, is of all of the options, unless there's a lot of equity and you can pull it out in a HELOC, is the most efficient way to do it, because they will allow us to take all of that housing expense, so you'll qualify for the new loan without having that extra housing expense. And if you're transferring your tax basis and you've owned your home a long time, that's really going to help your debt to income ratio as well.
And Donna's actually helping us with some clients where it's exactly that scenario. They have a home and they want to get another home, downsizing, or doesn't have to be exactly downsizing, but they want a home in a different location. And in order to be able to afford that, they had to sell their old home. But in order to be able to sell their own home, they have to be out of there, right? So there's a lot of moving pieces. And do they rent, or do they try and find something and then just move in? That way they don't have to rent. Yeah, a lot. But that when you said $20,000 a month in medical expenses, that hit home a little bit. That is astounding, and it's true. As you get older, you're going to have more issues. I, for one, thankfully don't have issues, but I can tell that as I get older, starting to have pains here and there. My eyesight's starting to go a little bit, so definitely seeing the signs of age, and as a result, realize that later on in life, you're just going to have more medical expenses. I see it with my parents. I see it with friends that have parents. And I expect that to be the same with me. And for a lot of people, that eats away at all the money that you saved up. So
yeah,
having,
it has with this woman.
Yeah, having those options are important. So thank you for that. Now,
yes, and well, I'll add one more thing if I may. Everything Yuliya talked about and everything I've talked about, I think the best advice is sort of like, buying auto insurance. Don't wait till after you have the accident. You need to do these things preemptively so that you don't get, because this particular client I was referring to, she's only got a couple more months left of her expenses, and then we don't know what she's going to do. I have another financial advisor who is referring me a client. She's client's in her 70s, but mama's in her 90s. And she's run out of money. And so now her client is taking money out of her retirement account to take care of her mother's house. So these are all situations that could be avoided if you take care of these things ahead of time, if you do it proactively.
No, great information for sure. And we do have a question that came over, and I think it's really going to be something that you and Yuliya can probably mention about, because there is something about an heir and somebody passing away. So the question is, can you share a bit about the process of transferring the mortgage from the principal borrower to the heir in the case of their death?
Mortgages are not transferable. So
that's easy.
Yeah, that's the easy answer. So if it's a spousal situation, ideally both spouses are on the loan, and if one passes, that then and the other keeps paying the payments, we have no problems. In fact, when couples come to me, and every once in a while there's a situation where we need to not put both parties on the loan, usually because of credit, it's always something I take time to advise them that when it's possible, we need to put the other spouse on the loan. They'll both be on title, but not on the loan, and that can create problems for them if the non-borrowing spouse is the one who outlives the borrowing spouse. So, but by and large, loans are not transferable under any circumstances, and they definitely don't transfer on death. So whatever situation that Yuliya has helped the individuals devise, in terms of how their assets pass forward, then the heirs will take care of the loan either through a refinance or a sale.
All right, wonderful. Any other questions from our audience? I know we have quite a few clients out there, or this has been shared outside of our KIOP sphere. So if you're thinking about estate planning, can answer your questions. Otherwise, I do want to make sure that you guys have Yuliya and Donna's information, so that if you have any more questions after today, you can reach out and see if they can help you with your unique situation as well. And let's see, contact details, here we go. So feel free to screenshot if you're on your phone or on your laptop. That way you can get that information and save it and be able to refer to it in the future. But I think we're up on time, right? I think we only had an hour, so we're 6 minutes over. I do want to thank Yuliya and Donna both for speaking to us today, sharing some valuable information, eye-opening information in certain cases, and hopefully this will, light a little bit of a fire underneath you to encourage you to reach out to a professional such as Yuliya and Donna to get things in order, so some of the unfortunate circumstances that we've covered today don't happen to you. But thank you for attending another one of our seminars. Look forward to seeing you guys at another seminar in the near future. Yuliya, Donna, thank you so much.
Thank you
Thank you for
me.
having us.